Good evening, friends. Welcome to all the participants. Welcome to this penultimate session in the budget series that we are having, Unlocking the Finance Bill 2025. So today we have CA Mehul Jain, who will be deliberating on the amendments proposed in the context of domestic taxation, as well as changes proposed in the TDS and the TCS framework. So before we hand over the proceedings to Mehul, a quick introduction about his profile. So CA Mehul Jain is a qualified chartered accountant, also is a graduate for BCom and law as well. Currently associated as manager at Tax Compass Advisors Private Limited. His areas of work and expertise include focusing on corporate tax, transfer pricing litigation, advisory, and compliances. Prior to Tax Compass, Mehul has worked with Dhruva Advisors as well as Grant Thornton. Mehul, warm welcome to this particular session and thanks for accepting. I would request you to take it forward from here.
Sure. Thank you so much, Karthik, for the introduction. And we'll get started now.
Sure.
Hello, everyone. Hope you guys are doing well. And most of us are in the past couple of days, we might have been talking about the budget and preempting what can happen in the next couple of days, given that, there is a little bit of discussion going on the new tax coming in, the new income tax going to be spoken about. We are going to look into the new regime of taxes, quite a lot of predictions and preempting going on. But if you were to ask me my immediate thought, my immediate view, whether there is going to be a complete revamp of the income tax, maybe not. All right. Because if you were to see the speech given by the Honorable Finance Minister, it was very clear that we want to do something which we have already done with the Indian Penal Code. All right. So if you were to see what has happened in Indian Penal Code, they have just changed the code, made it a little more relevant with the current scenario, and removed the redundant sections, removed the redundant provision. So on similar lines, if you were to ask me, I would see not the complete income tax getting revamped like how it has been done already in case of service tax, or I would say in the indirect taxes. Here, rather, my immediate thought would be there could be only redundant sections getting removed and making it more relevant. But like I've already mentioned, quite a lot of predictions going about. We might want to wait and watch what is waiting for us in the next couple of days. So now, like the plan is already scheduled, we are going to spend some time discussing the budget, all right, from domestic taxation perspective per se, wherein we are going to look into what changes. I'm sure everybody has already looked into it, but we're going to spend some time on what could have been the motive of coming up with a change or an amendment in a particular section or a provision for that matter. Overall, budget, the finance bill as such, without restricting ourselves only to the income tax, commendable job. All right. This is my personal opinion, goes unsaid. This is nothing to do with the place where I work, or it is influenced by anything for that matter. My personal view, it's a good budget where for a change, this time the motive has actually come in place to ensure that the middle class gets relief. All right. So a lot of us have already spoken much about how the tax rates have been changed and how much is the benefit that each one of us are going to reap over a period of time because of this. So without spending much time, let's get started with the domestic taxation and what are the recent amendments, what could have been the reason for coming up with a particular change. Let's spend some time understanding that. So our focus is on domestic taxation, like I mentioned, and the first topic that I'm going to talk about is your ULIP. All right. So there was a lot of discussion happening. This was something which we were all eagerly waiting when it comes to a unit-linked insurance plan, as in how do you go about with its taxation. What happened was under Section 1010D, Proviso 4 as well as Proviso 5 of Section 1010D says you will not get an exemption on redemption of anything. If your insurance plan is getting redeemed and if you're getting something from the insurance company, you will not get any exemption if the premium payable was more than 2,50,000. Now the concern is, fair enough, we don't get the exemption, but where would it be taxed? Whether it will be taxed as capital gain or whether it would be taxed as income from other sources, there was a lot of uncertainty. Now, through the amendment proposed, The redemption has been categorically covered under the head capital gain. So the uncertainty whether it will be taxed as capital gain or whether it would be taxed as income from other sources has been removed. Second thing, how would you tax this capital gain? As in, agreed, it will be taxed as a capital asset. You're going to derive any gains or losses coming in will be taxed under capital gain, all said and done. But how would you treat it as a capital asset? Whether it will be a debt-oriented fund, an equity-oriented fund, how do we go about? So for this as well, the highlight has been in the proposal wherein it has been specifically called out that this will be treated as an equity-oriented fund. All right. So going forward, if this proposal passes by, of course, the proposal, once it has got the assent from all the requisite parties involved, it will be made clear that all the redemption of ULIP will be taxed under capital gains, under the head capital gain, first point. And the taxability has to be evaluated from the perspective of equity-oriented fund. So you are going to treat the ULIP as such as getting covered within the definition of equity-oriented fund. For the sake of completeness, I would quickly read out the pointers here. ULIP to which the exemption under Section 1010D of Section 10 does not apply is proposed to be capital asset going forward. All right. And the uncertainty whether it will be treated as capital gain or IFOS has been cleared. It is going to be considered as capital gain. And ULIPs to which the exemption under Section 1010D does not apply is proposed to be included within the definition of equity-oriented fund. So in simple, the ULIP is going to be considered, the redemption, I would say rather, the redemption of ULIP would be covered under capital gain and the taxation would be as it would have otherwise been taxed for an equity-oriented fund. Now, another very interesting, very, very important, I would say, the benefit which has to be extended to the startups. A quick survey was done to evaluate how many startups have actually taken the benefit of Section 80 IAC. Before I get on to the benefit, just to spend some more time on understanding what exactly is the benefit available for a startup. If you are a startup which is registered, and if you were under the existing law, I would rather say, if you were incorporated any time before 1st April 25, you would be eligible to get 100% deduction for the, rather I would say the exemption for whatever profits that you made for 3 consecutive years out of a span of 10 years. All right. So this was the plan. Now, if you were to ask me based on the survey, only 11% of the startups have been able to take the benefit of this. So if you see, almost 89% of the startups have still not reached either their profitability or whatever it could be said. So to ensure that a larger chunk of startups get covered within the benefit of this, the proposal now says that the benefit will be extended up to April 1st, 2013. The interesting part is they haven't done, or in this budget, the proposal does not intend to give the benefit for a year or two. Rather, a benefit for next 5 years has been extended. So it is a commendable proposal, if you were to ask me, to ensure that those companies which will start making profit now, at least they can tap in the benefit of this exemption for 3 consecutive years out of a span of 10 years. So goes unsaid, of course, it is more from the incorporation perspective. So the startup has to be incorporated on or before April 1st, 2030, unlike April 1st, 2025, which is the current provision. All right. So this benefit is going to ensure a lot of startups get the deduction for 100% of the profits which they have earned. This is in terms of the startups. To quickly read the pointers here, the first thing, like I've already mentioned, till April 30, 2030, you can incorporate your startup and go ahead and avail the 100% of the profits gain or and gains which you derive from the business income for a consecutive period of 3 years. The deduction will be allowed, or rather was under the current provision is allowed only if you're incorporated before April 2025. The proposal is to extend the benefit of threshold to ensure that all those startups which are incorporated up to 2030 will be eligible for this. Very, very important. The amendment is applicable from financial year 24-25. It is quite obvious that this has to get effective during the current period itself, because 1st April is going to be anyway anytime soon. So to ensure that the benefit is continuously available to people, they have ensured that this amendment is effective from financial year 24-25 itself. The next thing which could be covered under the whole ambit of domestic taxation which has been proposed. In the speech, the Honorable Finance Minister has specifically called out, or rather, the whole motive was to rationalize the TDS rates. But unfortunately, they have missed out on this point. They have not rationalized the TDS rate for so many sections. Rather, the threshold has been changed. The rationalization of TDS rate has been done only for two categories of TDS, all right, or I would say under only two sections, one being income in respect of investment and securitization trust, and the other being 206C, wherein the TCS rates have been reduced. So although the motive was to reduce the rate or rationalize it as much as possible, I wouldn't say reduce, but to rationalize it across various sections, but only the threshold has been changed and not rationalized. So are we still living with a list of TDS sections? The answer is yes. We are still living with the same list, just the fact that this time the threshold applicability will change. The important point which I want to focus here is on the TCS, wherein forest produce has been defined. In the ensuing slides, we will look into what is forest produce and how will it impact. As of now, on this slide, under Section 194 LBC, the income in respect of all the income which you derive from your securitization trust has been reduced to 10% irrespective of whichever category you fall into. Whether you're an individual or whether you're any other category, the TDS rate would be 10% across all the categories. The second thing, the TCS, like I've already mentioned, they've just reduced the rate from 2.5 to 2%. So very important, this is also going to be applicable from 1st April 25. So effectively, we are talking about 25-26. The next thing is, like I mentioned, rationalization of TDS thresholds. They've gone about with reducing, or rather ensuring that the compliance or as many transactions which can be kept outside. They've tried, they made an attempt, but how much of it would see the daylight or might be something that we will all have to evaluate. So if you were to ask me, the thresholds have rather been increased, wherein we see under Section 193, they've increased the limit to 10,000. Under 194, they've increased the limit from 5,000 to 10,000. 194A, they've increased the limit to 1 lakh. Very, very important for all the senior citizens. This is going to gain a lot of momentum because the threshold limit as such has increased. If you were to see, the whole objective is to ensure wherever possible the threshold goes unsaid. 194B and BB, they have not increased the threshold. It is remaining as such. 10,000 during the year was the whole transaction, which, or rather during the entire year, 10,000 was kept as a limit. But here, the limit has now been revised to a single transaction. So any winning from a lottery, crossword puzzle, or a horse race, you're not going to look at 10,000 throughout the year. You're rather going to look at each and every transaction, whether it is increasing, it is going beyond 10,000. So this is the revision in terms of a couple of sections here. Next, insurance commission from 15,000 to 20,000, 194G, which is for your commission, prize money, etc. on lottery tickets, have been increased. Commission brokerage has been increased from 15 to 20,000. Most important is the TDS on under Section 194I. If you were to see, the limit earlier was 240,000 during the entire financial year. This time, the limit has been revised to 50,000 per month. All right. So in a normal scenario, if you were to ask me, now the limit has been increased from 240,000 to 6 lakh rupees. Goes unsaid, it is 50,000 per month. So you will have to evaluate this on a monthly basis. At the same time, 6 lakh in a normal scenario. Fees for professional and technical services has been revised and updated to 50,000. 194K, 194LA as well. The revision has been increased on a multifold. So this is the rationalization of the TDS threshold, not the TDS rate, unlike what has been mentioned in the budget. All right. So during the speech, I'm sure the madam did mention about rationalizing it as much as possible, but the thresholds have been revised definitely. Next thing is on the forest produce. So what is this forest produce definition and why are we even talking about it? Earlier, the forest produce under Section 206C had mentioned that you are going to collect the TCS at a rate of 2.5%. However, the definition of the word forest produce was not clear. All right. Now, what happened with the proposal? Only the forest produce which are obtained from a forest lease, or anything which is from a timber or tendu lease is going to be effectively exigible under the TCS provision for 2% and not 2.5%. Earlier it was 2.5%, now it is going to be 2%. TCS for timber and profits and forest produce is going to be reduced, and any other forest produce for not being timber or tendu leaves have been removed from the TCS gambit. So the entire forest produce not falling under the above categories, which is either tendu leaves or timber, is not going to be exigible for any TCS. All right. So this is a welcome move wherein the TCS as such, the burden of compliance of TCS has been removed, and only a selective portion of the forest produce has been kept under the ambit of Section 206C. The next thing is a very, very much a welcome move from, I would say, majority of the players in the industry, because there was always a confusion whether TCS has to be done or TDS has to be done. There are transactions, of course, there have been FAQs, there have been quite a lot of deliberation, which comes first. And to some extent, if you were to ask me, we have come to a consensus whether it is going to be 195Q, 194Q, or whether it is going to be 206C. But because of this, there have been quite a lot of compliance issues. There have been quite a lot of burden. And I would say there was a hindrance to the ease of business. And therefore, one of the most applauded move, if you were to ask me, is removal or omission of TCS on sale of goods completely. All right. Of course, 206C 1H had its own conditions in terms of the turnover, in terms of the billing to be done. All of that as such now has been completely omitted. Goes unsaid. It's a proposal, and we all hope it gets through. And once this happens, the corresponding changes in Section 194Q would also be brought in. So now, effectively, if there is any sale of goods which is exceeding 50 lakh rupees, only will be exigible for a TDS from the buyer or the payer, which is going to be under Section 194Q, and there will be no TCS under this provision. So this is going to reduce quite a lot of compliance burden as such for people and for businessmen who can continue focusing on the business instead of getting entangled between TCS and TDS. So this is one of the omissions which has been recently proposed by the Honorable Finance Minister. Another very important move, which is purely from the perspective of reducing the entire compliance burden, has been brought in. So as per the existing law under Section 206AB and Section 206CCA, if at all the TCS is exigible on a transaction which is more than 50,000 rupees, all right, and rather the TCS collected, the amount itself is more than 50,000 rupees, or the TDS for that matter under discussion is more than 50,000 rupees, and if the other party has not filed the return of income, then as per the provisions of Section 206AB and Section 206CCA, the TDS rate has to be double than what has been prescribed under the normal provisions. All right. So to take a simple example, if suppose it is a scenario of 194J, all right, 10% is effectively what has to be done. But if you are covered within the ambit of Section 206AB and 206CCA, wherein the other party is not filing the return of income, and the transaction amount or the TDS component on the transaction is more than 50,000 rupees, then the rate under 194J will not be 10%, rather it will be double the amount, which is going to be 20%, or the rate which is applicable under Section 206AA. So now it's done away with the whole concept of non-filers of ROI, all right? So the whole benefit available is to ensure that there is no compliance issues. This is going to reduce a lot of burden on the businessmen as such, because we had to chase our other parties or the other parties to understand whether they have filed the returns, whether they have given a confirmation, not whether the TDS rate is applicable, is correctly covered. If not, we would be subject to a lot more of income tax and assessment procedures under Section 201. So to avoid all of this, this move reduces the burden as such overall across all the compliance holders. All right. So in order to quickly read out the pointers, in order to reduce the compliance bill or burden, The Finance Bill has proposed to omit 206AB and 206CCA of the Act, thereby eliminating the requirement of deducting and collecting taxes at a higher rate. Like I mentioned, the section provides double the rate under the normal provision for transactions which are entered with a non-filer of income tax returns. So deductors, collectors are required to verify the income tax return compliance status of the deductees, collectees, which is anyway going to increase the compliance burden and operational inefficiency. To do away with it completely, this section has been removed. So therefore, if the other party has not filed the return of income, you need not bother checking, verifying, ensuring that there is a return filed. None of this is your headache as a businessman. You can proceed with making the payment as per the exigible sections. However, the question is, if the other person does not have a PAN or is not having a valid PAN, will that section continue? The answer is 100% yes. It may be noted that the higher rate of TDS and TCS for the transactions entered with person not having PAN or invalid PAN will continue as it continues today. So if your party is not filing return of income, that's not your headache. But if the other party is not having a valid PAN, it is definitely your headache. So you have to ensure that the PAN is available, and accordingly you deduct the taxes as per the applicable section. Just in case if it is not, then you will have to take the rate which is prescribed under section 208. This amendment is again effective from 1st April 2025, once the budget also would see the daylight. Other changes in TCS. They've gone about with increasing the entire limit for collecting taxes, all right, or the TCS in case of overseas tour packages, wherein earlier the limit was 7 lakhs. That has been revamped and that has been made to 10 lakh rupees now, all right. And apart from that, it is proposed to exclude the remittance under LRS for purposes of education financed by loan from a specified financial institution from the ambit of TCS. To simplify, it is proposed now going forward, in case if it is an education financed by loan, all right, in case if the whole remittance being made outside is for the purpose of financing an education, then in that scenario, the LRS would not be, or rather the TCS would not be applicable in such instances. All right, so that has been kept outside the ambit of TCS completely. Provided goes unsaid, the conditions are, it has to be for the purpose of education, it has to be from the specified financial institution. So quite a lot of pointers covered here. This is from the TCS perspective. The next is something which each and every employee as such would be interested to know: increase in limits on income of employees for perquisite. So as per the current provision, Section 17 says that if your employer is giving you any sort of free of cost or concessional rates or any sort of perquisite, any benefit which is free of cost, anything which is at a concessional rate, and if that benefit is taxed as perquisite, or rather that benefit is already taxed as perquisite, if it exceeds 50,000, all right. At the same time, if there is any medical treatment of the employee and that cost is also borne by the employer, if the amount of cost incurred by the employer is more than 2 lakh rupees, then that excess component would also be considered as perquisite. Now, very interesting, there are a few companies which offer a medical, a medical reimbursement. It could be in terms of other benefits which might be available for an employee who is traveling. So quite a lot of benefits might be available which would exceed 2 lakh. To ensure that they continue getting the benefit, it is proposed that this limit of 50,000 and 2 lakh will be enhanced. However, what is the enhanced limit today? That has not been notified. We might have to wait and watch what would be this limit. As of now, currently, there is nothing which has been penned down as such of how much is going to be the threshold. The amenities read, the amenities and benefits received by the employees earning income under the head salaries below limit as may be prescribed would not be treated as perquisite. This is the proposal. The limit shall be prescribed by the central government, which is currently 50,000 rupees. This is going to be enhanced. However, what is the enhanced limit? That hasn't been spoken about. As per Section 17, the current provision, any benefit which is available or provided free of cost or at a concessional rate shall be regarded as a perquisite. The salary paid to the employee exceeds, or rather that perquisite, that amount exceeds 50,000 rupees. This amount has been revamped, and as per the proposal, What is going to be the amount? Let us wait. Let us all wait and hope that this amount is considerable, so that a lot of employees can get the benefit of it. Again, this is going to be effective from financial year 25-26, which is effective from 26-27 onwards, AY 26-27. This is in terms of the perquisites under section 17. The next important move, again, for ensuring that a lot of investments or a lot of savings can be plowed by people in schemes which are released by the government. One of such scheme is the Vatsalya scheme. All right. So the deposit which is made to NPS Vatsalya scheme for a minor child by a parent or the guardian will be allowed as a deduction under section 80 CCD 1B up to 50,000 rupees. Now, interestingly, this is available even under the new regime. So if a person is opting for a new regime, he would also be exigible, or rather this deduction would be available even to such person who is opting under the new regime. The whole point is this contribution, the deposit which is being made has to be made for the minor child, and the eligible deduction, the deduction is going to be given to the parents or the guardian, whoever are depositing such money. Interestingly, in addition to this point, there is another proposal which has been laid down, wherein if I am withdrawing anything from such scheme, up to 25% of the total contribution made upon withdrawal shall not be taxable, or rather I would say is proposed to be exempt going forward from financial year 25-26. To simplify and to quickly summarize, at the time of contribution, if the parent is contributing towards the NPS Vatsalya scheme for a minor child, it goes unsaid, it is for a minor child only, all right, the deduction available would be of 50,000 rupees, and this is under the new regime as well. First thing. Second thing, any withdrawal which is made from this NPS scheme, all right, or from this Vatsalya scheme, up to 25% of such withdrawal which has been made, all right, of your total contribution, up to 25% will be exempt from taxes from financial year 25-26. Now, in an unfortunate situation where the amount is withdrawn upon the death of a minor, that will be completely exempt from any such taxes. All right. So there will be no taxation in a scenario where it is being withdrawn, or rather the entire amount is coming into picture because of the minor's death. In that scenario, it would be completely exempt. 25%, like I've already mentioned, this is specifically to ensure that the conditions which are prescribed under the PF Regulatory and Development Authority Act of 2013 is also adhered to. So with that motive, ensuring that there is an alliance between multiple laws, regulations together, this scheme has been brought in, and this deduction has also been laid out. The next thing is on our discussion on the NSS, which is your National Savings Scheme. Any withdrawal which is made on or after 29th August 2024, such withdrawals along with the interest will not be taxable. Now, to quickly give you a background of where exactly are we coming and why are we talking about this, what happened was a lot of people started contributing towards the National Savings Scheme, all right, and all of these contributions might have been made before 1st April 1992. So what happened was the interest component which was getting accrued was taxable. At the same time, the withdrawals which were also arising from such schemes were also subject to taxes. However, the government stopped this scheme on in the first week of October, if you were to ask me, all right. And therefore, to ensure that this continues, the benefit, and thereafter, after October, if somebody were to go ahead and withdraw the interest as well as the amount, that would be prone to taxes. To ensure that this goes tax-free and to ensure that this is exempted completely, Section 80 CCA has been proposed to be amended, wherein deduction shall be allowed in respect of the withdrawals made by an individual on or after August 29, 2024 also. Why? Because the scheme itself has been withdrawn by the government. To ensure that there is continuity, people can withdraw their money which they had deposited once upon a time under the National Savings Scheme without any taxes. To ensure that this continues, Section 80 CCA has been proposed to be amended. This deduction is proposed to be provided only in respect of the NSS deposits for which the deduction under Section 80 CCA was allowed earlier. Goes unsaid, this deduction is going to be provided only in case if it is towards the NSS deposits made earlier. This is in terms of the National Savings Scheme. The next thing is amendment. Again, to quickly read out what exactly is 80 CCA talking about. Section 80 CCA currently taxes withdrawals account if the deductions were claimed for the deposits made earlier. Department of Economic Affairs notification effective from 1st October 2024 stopped interest accruals on NSS balances, leading to a taxable withdrawal from the NSS accounts. Proposed amendments provides a tax exemption of all of such withdrawals which are made on or after August 29, 2024 for deposits which were made on or prior to 1991-92. Goes answer. Annual value of SOP. All right, this is another very, very interesting aspect of the discussion which they have come up with. The proposal says that earlier, only one additional SOP was allowed, provided a few conditions were satisfied. Under the current provisions, the annual value of SOP is permitted to be considered as nil. So therefore, you need not offer that. Only in cases where the property is either occupied by the owner himself, or it is occupied, or it cannot be occupied by the owner because it is out of his place of employment, business, or profession. So this is the current provision. If you were to understand, there are multiple conditions attached to this annual value being claimed as nil. First, there can be only one annual value, or when only one self-occupied property wherein you can claim the annual value to be nil. Second condition, if you're not residing in it, either you reside in it, or if you cannot reside in it, then it is not a property which you can reside because it is not at the place of your employment or profession or business. To simplify and to do away with all such conditions, now it is proposed that 2 SOPs can be allowed with a nil value. All right. So the annual value of 2 SOPs can now be taken as nil if such properties are occupied by the benefit of the owner or for any purpose or is vacant due to any other reason. All right. No condition that it has to be at the place of business. It has to be at a place other than the place of business. No such conditions. They have done away with all of it. Now, in simple terms, annual value of 2 SOPs will be considered as nil. All right. This is to ensure that people can start investing. The first thing. Second thing, to do away with the whole confusion of conditions being satisfied. So to ensure that none of those conditions are levied and or rather put in place where people are facing hassles and burden, they have done away with this. So to quickly read the pointers here, under the current provision, we've already read. The proposal is to ensure that the annual value of 2 SOPs is going to be considered as nil if such properties are occupied by the owner for his own residence or it is vacant due to any reason. Prior to the proposal, benefit was given only for one single house. Finance Bill has proposed to relax the aforesaid provision by providing that the benefit of the nil annual value of SOP shall be allowed without the requirement of satisfying any of the condition. Goes unsaid, this is going to be effective from financial year 24-25 onwards. So for your AY 25-26, you can go ahead and consider this as not to be, rather, you can go ahead and consider this to be as a benefit available in terms of the number of SOPs that you can occupy. The next thing, the whole ambit or the whole discussion which is currently running around is in terms of the rates of taxes. Quite an interesting slab rate which they have come up with, but let me quickly draw in 2 points here. The first one, there is no change in the old regime. The old regime, whatever the current provisions are there, would continue as is. Second thing, in terms of new regime, they have increased the slab rates. Earlier, if you were to see, it was up to 3 lakhs where there was no taxes, and now up to 4 lakhs, there is no tax at all. The tax rate has been made 0. Earlier, more than 15 lakhs, if somebody were earning, they would be exigible for a tax at 30%. Now, this has been increased to 24 lakhs, wherein by addition of another slab of 20 to 24 being subject to 25%. All right. So with this slab coming in, most of them would end up paying taxes if you're earning more than 24 lakhs, only then you would be covered under the 30%, or else you would be at a rate lesser than 30%. Unlike the existing provision, where up to 15 or above 15 lakhs, automatically you would be eligible for taxes at 30%. So a very, very big welcome move. But with this comes another very big pointer to discuss. If you are claiming, or if you have any income which is taxed at a special rate, suppose it is capital gains, all right, which is being taxed at a rate which is prescribed in the section itself, that income will not be covered within the discussion of rebate. So let's take one step back and understand what are these rebates and where is it coming from. So as per the existing provisions of section 87A, rebate was given up to 7 lakh rupees, but now this has been increased from 7 lakh to 12 lakh rupees. The first point. Second thing, this rebate is not available if the taxable income is comprising of short-term capital gain or long-term capital gain, which are going to be taxed at special rate. To put this in a simple term, rebate is not available for incomes which are taxed at special rates. All right. So this is in terms of rebate available or not. The next thing is on rates. I've already mentioned, in case if your income is more than 24 lakhs, the benefit available to you, an additional benefit of tax which you would enjoy is 1,10,000 rupees. All right, because of the change in the rates. The next thing is marginal relief as such would be available for an income up to 12,75,000. All right, so goes unsaid, just in case if your income exceeding 12 lakh is lesser compared to the tax component which you would otherwise end up paying, you would be eligible for a marginal relief. So this is available only for the resident individuals in case if you're opting for the new regime. The maximum surcharge continues as it was at 25% under the new regime and 37% under the old regime. There is no change in the surcharge as well as the cess. I repeat, in addition to all of this, there is no change in the old regime rates. So that continues as it was. Just to take a quick slide, all right, to understand what would be the impact of the different classes of income and the rates and the tax benefit that we might end up enjoying. If you were to see up to 4 lakhs, initially both were having an automatic effect because of rebate available under the old regime. I would say under the existing provision rather, the effective benefit available would be 0. Once your income starts going beyond 8 lakhs, all right, once the income is beyond 8 lakhs, you start accruing the benefits because of the change in the slab rate proposed. So if you see, the maximum benefit available would be up to 1,10,000 rupees because of the change in the entire structure. So irrespective, once the income is up to 12 lakhs, there would otherwise be no taxes at all as against the existing provisions. The next slide is in terms of the exemptions from prosecution in case if there are delayed payments of TCS. So what is this provision talking about, or what is this discussion all about? If you were to understand, as per the existing provision, section 276BB provides for the prosecution in case of failure to pay taxes collected at source, or rather whatever you've collected, you weren't able to remit to the central government within the due date, then a prosecution could have been initiated against the person. To decriminalize this minor non-compliance, it is proposed that the bill proposes now that under section 276BB, in case if you have collected and if you've remitted on or before filing your TCS statement or your quarterly TCS returns, it will not be covered under section 276BB as long as you have remitted it to the exchequer on or before the quarterly TCS statement. This is going to be effective from 1st April 2025 onwards. All right. So this is the decriminalization of TCS.
Thank you so much, Mehul. That was a wonderful session from the Tax Committee at KSCAA. We thank you so much for sparing your time and sharing the insights on the budget. Participants, thank you so much for tuning in.
Indeed, a pleasure, Karthik. Thank you so much for inviting me as well. And thank you, each one of you, for giving your time. Thank you once again.
Thank you so much. Thanks. Bye.